the dollars to pay taxes come only from the government or its agents, and the currency itself is a public monopoly. So what are the ramifications of the government being the single supplier of the thing that it demands for payment of taxes? Well, the first ramification is it's the source of the price level. We need the government's money to pay the tax. They tell us what we have to do to get it. That is the expression of value. The mainstream does not have a source of the price level. They say the price level is what it is. They can attempt to tell you why it might change, go up. That's called inflation, or why it may go down. That's called deflation. If you say, well, why are prices where they are today? It's because that's where they were yesterday, plus or minus whatever the change was. Well, why were they there yesterday? Well, that's because they were there the day before, plus or minus whatever the change. They have nothing other than an infinite regression into the past, to sometime before the Big Bang to explain the source of the price level. And they've acknowledged that. And it's a big flaw or shortcoming of their models, but that's what they use. It didn't occur to them that it's a simple case of monopoly, and monopolists are price setter. This is a micro foundation because monopoly is a microeconomic concept. There will be some other contributions, but they're largely derivatives of the idea that the currency is a public monopoly.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley, and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia Pino.
And it's always our pleasure and a privilege to welcome back to the show MMT founder Warren Mosler. Warren, thank you so much for joining us.
Good to be here.
So, Warren, me and Patricia are getting ready to give an MMT presentation for activists soon. And the first item on the agenda is, what is MMT? And obviously, who better to ask than you? So, apart from it being originally called Mosler Economics, what is MMT?
The way I like to answer that is I kind of rephrase the question, which is, what contributions has MMT made to the study of economics? What are the MMT contributions? And the first one is sequence. Everyone before MMT, everyone thought that the government had to get money to be able to spend. So they had to tax. This is the federal government now. They had to tax to get money to spend. And what they didn't tax, if they wanted to spend more than that, they have to go out and borrow it to be able to spend it. And MMT has just turned that around and said it was backwards. That, in fact, the dollars to pay taxes come only from the government through its agents. And in fact, it has to spend first before the funds are there to pay taxes, before the taxpayers can pay their taxes. And to illustrate that, we have the MMT money story, which explains what MMT is. And the money story begins with a government that wants to provision itself. Now, other schools of thought have began their money stories with maybe people are engaging in barter and came up with tokens to make it easier or something like that. but they don't start with the state, with the government wanting to provision itself. They might start with people on a desert island and trading coconuts or whatever, and or using gold coins to facilitate commerce. But we just those are all. We don't deny those stories may have happened, but they're not relevant to today's state governments, which are states trying to provision themselves. And the way they do it is the first thing they do is they levy a tax on payable in their own currency. And they could levy a tax payable in a different currency, but they levy a tax. And I'll get into that. And for purposes of the example, I like to use a property tax. They put a tax on everybody's house. And the purpose of that tax is to create unemployment, which is an MMT contribution. Taxation is the source of unemployment is always tax liabilities. Okay, so they create tax liabilities, and everybody has to create unemployment, which is people looking for paid work who want that currency in exchange so they don't lose their house. And so, and the reason the government's creating unemployment is because it wants to hire those people to be soldiers and public health workers and educators and everything else that government wants to hire people to do. And so first it levies a tax. Okay, the next thing that happens is people are out looking for paid work. The next thing that happens is the government then hires those people with its otherwise worthless currency, as we say. The only reason you can hire people with those currency is they need it to pay the tax. Okay, so they levy a tax, creates unemployment. They hire the unemployed that their tax created. They then pay the people, and then the last stage is the tax gets paid. And so it's just like the movie theater or the football stadium. Nobody thinks that they collect the tickets first and then sell them. They have to sell the ticket first before they can collect it. The government has to spend its dollars first, its pounds first, before it can collect them. Okay, so that is the MMT money story. And to your question about like what is MMT and what I've turned into what are the contributions that MMT have made. So this story illustrates the sequence, which is the main contribution that has turned over politics and economics, I'd say, in the last 2 or 3 years. And it's totally turned over mainstream analysis. They no longer, okay, so because once you understand that the government has to spend first before taxes can be paid, there's no solvency issue. The solvency issue is moot. The crowding out issues are moot. All these things that had found their way into mainstream economics because of the presumption that the government had to get money to be able to spend, the backwards presumption is now gone. And so those models have to be explained a different way. The narrative has to change. The equations are the same, but the idea of what's the function of what and what the risks are has all changed. Okay, so sequence is number one. Number two is in that sequence, we see revealed the micro foundation of MMT that is a contribution that hasn't been, doesn't exist in the other schools of thought, and that is that the currency itself is a public monopoly and the ramifications thereof. So what are the ramifications of the government being the single supplier of the thing that it demands for payment of taxes? Well, the first ramification is, of course, there's no solvency issue, but the ramification is that it's the source of the price level. We need the government's money to pay the tax. They tell us what we have to do to get it. That is the expression of value. So if they say you have to, if you want to be a soldier, we'll pay you $50,000 a year. That value, they're then introducing that notion of value into the economy. We have to, we need their money to pay the tax. We have to be a soldier to be able to get it, or we have to be a public health worker, whatever it is, to be able to get it. That is a defining point of what the value of the currency is. That's where the government's information as to what the value of the currency is introduced. And that the numeraire, the dollar, or the pound is assigned value based on what the government demands in exchange for its currency that they've got and we need. And it's a coercive system, and they're the price setter. So the mainstream does not have a source of the price level. They say the price level is what it is. They can attempt to tell you why it might change, go up. That's called inflation, or why it may go down. That's called deflation. And if you say, well, why are prices where they are today? It's because that's where they were yesterday, plus or minus whatever the change was. Well, why were they there yesterday? Well, that's because they were there the day before, plus or minus whatever the change. They have nothing other than an infinite regression into the past, to sometime before the Big Bang to explain the source of the price level. And they've acknowledged that. And they say it's just historic. And it's a big flaw or shortcoming of their models, but that's what they use because it didn't occur to them that it's a simple case of monopoly and monopolists are price setter. This is a micro foundation because monopoly is a microeconomic concept. And everyone wonders what are the micro foundations for your macro theory. This is it. Okay, right there. The currency is a public monopoly. So those are the two things that MMT has contributed to the history of thought, to the other current schools of thought that don't have them. And there will be some other contributions, but they're largely derivatives of the idea that the currency is a public monopoly.
A lot of progressives take interest in MMT, and we're always asked this question about, how political MMT is. To some people, it's not political enough. To some people, it's too political. Depending on what side of the political spectrum, they might throw different accusations at MMT, and it's something that tends to cause quite a lot of confusion. So I was wondering whether you had a very clear explanation of what MMT's relationship with politics is and why it matters.
We have a monetary system. That's, a tool that government uses to serve public purpose, is the theory, at least that's why they use it, whatever that may be. And what MMT says, yes, monetary system is a tool, but you don't understand that tool. There are other ways to use that tool. You're presuming limitations that aren't there. You're presuming things it does that it doesn't do. Here is how that tool actually works. And we're giving a description of the monetary system and how it works. And this reveals policy options, whether they're right or left of it for anybody's politics. And it reveals fallacies of logic that are being expressed now as in policy proposals and policy that's been enacted. And it shows the folly of these policies that have been enacted on misunderstandings of how the tool set works.
What you're saying is that our current political order is sustained through a misunderstanding of the mechanics of money.
Yeah, so let's say I have this tool, and it's a pair of pliers, and nobody recognizes that pliers can open and close and grab things. They've just been using these pliers to hammer nails. or worse, right?
Yeah.
And we point out, look, it can do things. It's got a certain amount of strength. Here's all these things we can do. It's going to be a lot easier to loosen these nuts and bolts if you figure you open the pliers and grab onto them and twist it rather than trying to hammer the nut off the bolt, And so, that's left-wing theory. It's like, okay, whatever. But, it's not a great analogy, but it's enough of an analogy, I think, to make the point.
Yeah, I think it's a good analogy. Yeah, definitely. I mean, that nail is going to get banged in if you use the pliers to do it. But it's not what the pliers were invented for, and there's probably a better way to bang a nail in.
Yeah, this paint can opener can also be used to unscrew screws from.
Yeah.
When you got the tool for something that you don't understand, especially if it's a computer, right? There's all these things this computer does, and you've been using it for emails, and suddenly somebody shows you how you can do all these calculations. You say, "Oh, well, that's communist. That's socialist." Okay, to show you how your computer works, or that's right wing. You're just trying to enslave everybody. It's like, okay, sorry, I mentioned it.
This is exactly the pushback you get, though, isn't it?
Yes.
So, I had a kind of follow-up question, which kind of gets to this: authorities deciding what is and isn't money. And so, in the case of currency issuing governments with floating exchange rate currencies, only the government or its designated agents can create the national currency. But for skeptics, so we had a question.
They can only create the thing that's accepted for payment of taxes.
Yes, sorry, I am colloquially calling that the national currency.
Right. So when you remove it a step like that, then you open yourself up, because people think credit cards are currency or something. So you can avoid all that just by saying what it is, right? So it's best to avoid ambiguities that create discussions that you really don't want and don't contribute.
So we had a question this week from one of our listeners, John Lowe, and I'll put it to you now, Warren. John writes, one area that MMT ignores is the equity markets. MMT theorists see it as just another form of savings. That does not take into account IPO creation. If I started a company and that company issues stock, that stock becomes valued in money terms, no savings involved. So have I become a creator of money?
Okay, so apart from getting into a discussion of the definition of money, what it is a financial asset. Same as a dollar deposit at the Fed, or the same as a commercial paper issued by General Electric. It's a financial asset. It's denominated in the dollars or the currency. It's not denominated in widgets or something like that. So it's a financial asset, and on the books of that company is a financial liability. It's a liability of the company and an asset of the holder. And so it's not a net financial asset, but it's not. It's what it is. It's what's called the bottom of the credit stack. So in a company, they have liabilities that they issue, which could be bonds, or notes, or accounts receivable, payable, things like that the company owes, all their liabilities. There's like a pecking order for which you have senior debt, and then you have which gets paid first, and then junior debt, which gets paid second, and that's called the credit stack. All their outstanding obligations, and at the bottom of that is the equity, which gets whatever money is left over. So on the asset side, you have all this, or on the income side, you have all this income. It gets paid out to whoever gets paid out first. The last place it goes, whatever's left over, goes to equity. So the company, it's a corporate liability. The company owes whatever's left over after paying everybody else to the shareholders. And so it's not a net financial asset. And as the profits of the company grow and there's more left over for shareholders, then their liability grows because they owe you all that money. So in dollar terms, it grows. So in that sense, it's consistent with the whole idea that within a sector, you can't create net financial assets. But it is a gross financial asset. It does grow in value, and it has collateral value that gets used for leverage, and it is expressing a collateral value the same way the price of a house is, or the price of any other commodity is expressing the price is an expression of value, and it's part of the net worth of the holder. I'm not sure why they would say MMT ignores it. I haven't written extensively on the stock market, but you can't write on everything, right? And I've certainly pointed out that certainly in my career as an investment manager, I keenly aware, no pun intended, of the
Hi, Steve, if you're listening,
of exactly what equity is and how it works and what it does and how it gets valued and why, and what the technicals are as well as the fundamentals. I've lost a lot of money in the stock market to prove it. As I said.
My response would be, if by creating company stock you create money, why would you then put it on sale and sell it for money? You've already got money.
Well, look, you could have a bond, a government and treasury security bond is just dollars in a time deposit at the Fed. So that's money in a time deposit. You can sell it for money because it's got an interest rate component that can be worth more or less depending on the interest rate environment. The Fed lowers rate, the fixed rate is worth more. And so you've got a equity situation, which is a corporate liability. It's denominated in dollars. It's a financial asset. And it varies depending on the perception of how much is left over after the company's expenses are paid, plus technicals, of course. And so the question is, okay, it's a financial asset, the same as all those other things. What's the reason that we're discussing whether it's money or not? What's the further purpose for using the word money? Is it because money causes inflation? Is it because it's a measure of wealth? Should we be saying it's nominal wealth? It's certainly nominal wealth. Is money just like what you have in your pocket? Why are you defining money? Why do you define anything? The only reason you define anything is so we all know what we're talking about, for some further purpose. So if you want to call all financial assets money, fine. Then we're creating money. So what? Whether it's money or not, why does that matter? Oh, it matters because inflation is caused by too much money. Okay, so if you want to say, so let's get to the question then. Does the equity market cause inflation? And that's a legitimate question, but you don't want to trick me into the answer by saying, well, it's money. Well, okay, therefore it causes inflation because money causes inflation. With that kind of a convoluted stream of logic, right?
I think when people ask questions like, have I created money when I do X, Y, Z, is because we say things like, only the government and its agents can create that which is accepted for payment of taxes. And they're trying to find loopholes. What happens if I do this? I can pay my taxes like that.
Then the question is, can I use that for payment of taxes? That's the question, not is it money?
Fair enough. So rephrasing his question, making the presumption that's what's behind the question. Has he created something that's acceptable for the payment of taxes?
Right. And only the state or its agents can do that.
Right.
Can designate something acceptable for tax payment.
So the short answer is, if we can just presume that's our definition of money, that which is acceptable for the payment of taxes, then if you create stock in a company, and
that can't be used for payments of taxes. It can cause inflation. You can borrow against it, buy things, but the stock per se isn't used for payment of taxes, nor are any corporate obligations.
I was going to mention actually what you said, Christian, that their point is usually to try and catch us out and say, oh, actually, I know of this other thing that creates money and has nothing to do with government. But the other aspect of that is they want to sort of, that is in support of the idea that there is kind of a free market out there, and that has nothing, that is completely independent of the government. And on that, I think the argument as well would be flawed, in the sense that the stocks, everybody knows that for a healthy stock market, whatever that is, you need an enforcement of contracts. And so the government is sort of behind that as well.
So what point are they trying to make, though, about stocks? That there's a market where they trade? Fine. So what? I mean, nobody's denied there's a stock market where you trade things. It's not inconsistent with anything. There's a place where you can trade fish down at St. Croix here. You can go in. There's a fish market. So what's that going to? Why is that? Why does that prove that the government doesn't spend first and then taxes are paid? Why does that prove the government's not price setter? It doesn't. It's got nothing to do with the MMT assertions. Nobody denies that people trade things with each other at whatever price they want, at whatever hours they want.
So once people get their heads around this concept of currency being issued by the government, and that the government can't run out of its own money?
Well, it's not that it can't run out. It's just not applicable. When you have to spend first, how can running out be even a consideration? Running out means you can't get it. But if you're the originator, that just doesn't apply. So there's another thing there where they say, well, so-and-so country defaulted on something. And it's, look, you have to understand the difference between ability to pay and willingness to pay. The government has the ability to pay, doesn't mean it has the willingness. It may decide not to pay you, which could be a default. That's fully recognized by MMT, that distinction, as it is by every credit ratings agency and everybody else. It's not some kind of proprietary distinction, that there's a difference between ability and willingness, right? People say it's impossible for government to default. It's like, no, it's not. They just say, no, we're not going to pay you. They do it all the time, right? Government owes me money for this, and they didn't pay me. They didn't run out. They just didn't want to pay you.
I always add the word that they can't involuntarily default.
Yeah, they can't. I just use it for the positive. Look, they have the ability to make any payment they want in their own currency.
So that given, after that, they wonder why governments do this thing that gets called borrowing. So we had a listener highlighted to me, his name's Kevin, he highlighted to me that in an interview with an economics professor that I'm very fond of, but possibly doesn't see monetary operations all the way through to their implications. And in this interview, this particular professor explained that the US government borrows and the main lenders are private corporations and the rich, and that a third of the debt, around that figure, a third of the debt is lent from China. So, Warren, what's actually happening when corporations buy US government debt?
Yeah, so here's the thing. The Treasury does borrow because Congress instructs it to do that. So it's not that the government as a whole is borrowing, but the Treasury is borrowing on policy. It's a policy that has been set by Congress for the Federal Reserve not to lend to the Treasury. So the Federal Reserve is also an agent of Congress just as much as the Treasury is, right? And so they've set up a set of procedures where the Treasury has to borrow to be able to spend. But they wind up getting those dollars from the Federal Reserve, which is another agent of Congress. So Congress has the government, so to speak, when you look at it as a whole, borrowing from itself to be able to spend. And why do they do that? Well, look at all the other things Congress does that you can't explain. That's trivial next to some of these other things that they do. So, but that's the way it is. That's what they've set up. But as a point of logic, they, all the funds are coming from the government's agent, the Federal Reserve, when it credits accounts. They don't come from anywhere else, so they can put all the policies and procedures in place they want. But at the end of the day, they can't change the fact that any more than they can repeal the law of gravity just by having a vote in Congress. It's not one of those laws, right? So the government is going to do a reserve add before it does a reserve drain. They're going to spend first, provide the funds first before they remove the funds, as a matter of accounting. There's just no way around it. If you think you found an example where they're doing something else, then you just haven't looked hard enough. What they're doing, in a very close examination of all the debits and credits, is they're crediting the accounts first. They're spending the money first, and they're borrowing back their own money that they just spent. If you want to use the narrative of borrowing, that's what they're doing. I'll give you $100 so that you can loan it to me. Why? Because Congress has set up this policy that, gives them no choice but to do something, absurd like that. But that's why they're doing it. Not because there's any financial imperative to do that.
Once people have kind of get those kind of things clear in their mind, the next thing they get hung up on is inflation. And we talked a little bit about this at the beginning, but you're working on a framework for the analysis of the price level and inflation. And at the beginning, you talked about the government revising the value of its currency downward if it pays continuously higher prices for the same thing as it moves forward in time. And so that there's that. And then there's a couple of other channels that sort of affect the price level, if that's the right way to put it. Could you tell us more about that?
Markets work to determine and express relative value. So they'll tell you, silver is 75 times gold, or let's say 100 times gold. So if silver's $20 and gold's $2,000, the market, that ratio is what the market has determined. Okay, so you look at if the price of silver is $20 and the price of gold is $2,000, market forces have determined that those express relative value, that gold should be 100 times silver. Now, if we were to switch to yen, the prices would be different. They'd be 100 times higher. So silver would be 2,000 and gold would be 20,000. But gold would still be 100 times silver. And if you switch to euro, it's going to be a difference of 100, 1.19 or something. So it's going to be 18 euro and 1,800 euro or something. But it's still going to be 100 times higher. So what market forces do is they tell you the ratio between all these things in the economy that have prices on them. Markets don't care whether, it's euro or it's yen or it's dollars. So they're going to have the same ratios. The models are there to show you that, ratios exist because people have indifference levels, and there's, and things will get bought and sold, and they will always express these indifference levels, and you get ratios. So you don't. But where does the absolute value come in? How does the market know it's dollars and therefore it's $20 for silver and 2,000 for gold? And that information has to come from outside the model. It's exogenous, and so in this case, it's outside of the economy. And it comes from government, because the government is a monopolist. It sets the price of something when it buys something. It tells you you got to make $50,000 to be a soldier. Now the market has that information to hang its hat on, and from that it can say, okay, if a soldier gets $50,000 in silver, you got to mine it, you got to blah, blah, and got to do this, and say, I like it, it's shiny, it's $20 an ounce. It filters all that out. And if the government had said, soldiers are going to get 100,000 instead of 50,000, that's where value is. What value is now? Silver would go through the whole, computational process, market process, and will come out to $40, twice as much. The information that assigns absolute value, the dollar value for something, like a soldier or for, unemployment check or for whatever the government's pricing at the margin, has to come from the outside. It comes from the government. The market can't determine that. The market can then take that information and from it figure out relative prices for everything. Now, when it figures out those relative prices for everything, it's going through a lot of government influence in that process. There might be, rules on how you can leach chemical, what chemicals you can use to mine gold that would cause things to happen, or there's taxes in place. There's a whole government, a filter on this thing that causes markets to express all kinds of prices, because they take all that. And that's called the institutional structure. They take all that institutional structure into account. So you have the government setting price, and then it's got to get the government's also set up an institutional structure, which is part of price setting. And out of all that comes market prices. Okay, so the information that's coming from government is prices paid plus institutional structure, the dance you have to do to get the money. And that's the information coming from government. Then the market's expressing the relative value after that. So if suddenly there's a big gold discovery, and now gold is only worth 50 times silver and not 100 times in the marketplace because of supply and demand, relative value. Now silver might be 20 and gold might be 1,000 instead of 2,000. Or the opposite. You get some galleon full of gold sinks or something like that, and so gold might go from 2,000 to 4,000. And now silver's at 20, and the markets will express the relative value of that gold as supply and demand changes. Some of that we call inflation because we use consumer price index. So if lumber prices change, that flows into housing, and housing is part of the CPI, the consumer price index, the cost of living. And it might just be a relative value change because the lumber's in short supply and the price goes way up, but it'll show up as inflation, as what is called inflation, because we're using CPI as a proxy for inflation, where it's not. It was never meant to be. It was meant to be consumer price index for purposes of figuring out what the cost of living is, not what the value, what's happening with the value of the currency. It was just a cost of living thing. So it's not wrong. And when you're giving somebody a pay increase or not, you want to know what the cost of living has done, because it helps you, with that kind of decision. And so we've got two things. We've got the price level. Well, so this is all about the price levels. There's two things that influence the price level. Number one is the information supplied by government. Number two is markets expressing relative value. And all that combines to what you could call the price level at any one point in time. Now the question is, what makes that price level change, which is what we would call inflation today. But I'll come back to it, but it's not what I call inflation. I just call it a change in the price level. Okay, because right now we use inflation for everything. If you put more air in your tires, they're inflated, right? So it's not wrong. Okay, and if the price of spaghetti goes up, we have spaghetti inflation. If the price of haircuts goes up, we have haircut inflation. So it's just become a generic word. It's not giving you much information in terms of monetary system, economics, price, all that stuff. But it's not a bad word. It's just not particularly useful because it's all this other stuff now. Asset prices.
Ironically, it's been devalued.
Yeah, and we had grade inflation because it was easier to get higher grades, remember?
Yeah.
So it's like, okay, let's raise interest rates to bring down grade inflation. It's just not something that's connected to anything that we're monitoring.
What would your preferred measure of inflation be? Just simply taking the price of absolutely everything in the economy? Not just the representative basket?
The measures are okay. The question is, what do we do about them if we don't like them? Okay, and so we have the price level, which is set. The information, the only information of absolute value comes from the government. In the case of a job guarantee, it will be the JG wage, would be the input from the government, and all the government's institutional structure, which includes how contracts are awarded and who gets what. You have to have union people or you don't. All these things filter into the price level. So we have the government component first, and then we've got the market using that to express relative value. So what you do about a problem or a perceived problem, if you want, or something you want to change or whatever, is you have to look at the source of what's creating this thing. So if the creation is that the government's indexed all its wages and Social Security and the JG wage to the the dollar index or something like that, so people can afford imports, and it starts going up, and so they're giving everybody raises, and we've got CPI going up, so everybody's screaming inflation. What do we do about it? Things like raising taxes and macro policy and creating more unemployment, probably not going to help that situation because that's not the source of where these price increases are coming. If we have a problem with lumber and the price goes from $300 to $1,700, like just happened, and because of COVID, because of tariffs, because of supply chain disruptions, presumably temporary, which turned out to be the case. It's back to 400 or something. Still a little high, but not 1,700. But while it was up to 1,700, we got this issue, and everybody's screaming it's from money printing, which we know has nothing to do with it. Okay, so the understanding that I'm giving helps you. You identify a problem because the price of housing is going up. You then look at what's making it go up. You then look at whether this is relative value or this is based on government information. And now once you pick the one it is, now you've got a leg up on doing something or not doing something about it. I'm making a decision. Your decision-making process is vastly improved. Not that you can still make the wrong decision, but you just increase your odds of getting it right and of being effective in what we're trying to do. So right now, with the way we're looking at it, it's like no chance of getting it right, and 90+% chance of having it backwards and making it worse. Whereas the proper understanding of the actual monetary operations behind it all would would swing the odds the other way, where we'd have a 90% chance of getting it right, and no chance of getting it backwards. But notice I went through this whole thing about the price level and what makes it change without talking about inflation, because the only way you can get what we would call inflation today, which is a continuous change in the price level going forward from any of this, is if the government continuously changes, in this case, raises the prices it's paying, and maybe adjusts its institutional structure to make sure that every year we get a 5% increase, and you'll have a 5% continuously price level continuously changing at 5%. If the government raises a price, it pays for things one time and just leaves it there, you get a one-time adjustment, and then it doesn't change after that. So the measured rates of inflation by the authorities would be 5% the first year, then 0 after that. You don't have to go backwards to get to 0. If you're at 5% and then you go flat, you go to 0. You don't have to go up 5 and then down 5 to get to 0. Okay, these one-time adjustments just get ratcheted in, and that's it. And then you'll measure change after that. Now, that got me to thinking, okay, well, look, what is the rate of inflation? Let's go back to the beginning. Let's look at the academic definition. You read in the textbook, what do you read inflation is? And it's a continuous increase in the price level. What I make of that is it's a continuous increase in the price level faced by today's agents when making decisions, because that's what economics is all about. If I'm sitting here today as a jeweler, and I'm deciding whether to buy gold for today's delivery, or I'm going to be selling jewelry next year, so I want to buy some for delivery a year forward. To me, those are the decisions that are faced by today's agents trying to do business. If I'm a home builder, I'm building a house, I'm going to have to buy things along the way. If I buy my inventory now, I have to pay interest on the money. What's my cost for lumber today? What's my cost for lumber I'm not going to use for a year, that I'm going to put in the house to do the final trim a year from now, right? So agents in the economy look across time. If I'm a miner, a gold miner, I look at if I'm going to sell my gold, it's going to take me 2 years to produce it and refine it. So I have to look at how much can I get right now for gold that I'm not going to have until 2 years from now to be able, ready to sell. So what people in the economy are looking at are the term structure of prices that they're facing right now. And that's called forward prices. And any company that's trying to do any planning or selling things that where it has to price them for delivery next year, the year after, or 5 years forward. Maybe they're making machine tools for somebody who's going to take them 2 years to build them, or 5 years they have to build a factory. What price can they get right now if they want to lock in a price for everything that they're producing? If I'm buying an assembly line for electric cars and Ingersoll Rand's going to build it and deliver it in 5 years, what's my price right now? I can't just say, well, wait and see what the price is. I need to know the price now to be able to make a decision on whether or not to buy that thing, whether I can make a profit on it. And I'm going to need to know I'm going to be looking at where I can sell my cars and have indicators that'll tell me that. So anyway, if you look at it as the continuous increase in the term structure of prices faced by today's agents making real economic decisions, real prices that they can buy and sell at, to me, that fits the academic definition of inflation, both in intent and what it is. Right now, if you ask the Fed what's the rate of inflation, they don't know. They can't tell you. Or the Bank of England. They can tell you what it was last month. It was up 0.5, and we'll annualize that at 6%. Okay. They can tell you what their forecast is for next month. But what is the continuous rate of inflation that a businessman is facing right now making decisions? They don't have any idea. And they don't even pretend to. It's not what they do. Okay, but that number is the term structure of prices. And ironically, that term structure of prices is a direct function of the policy rate of interest. So if the rate of interest is 0, then gold for today costs 2,000 euro, it's 1,700 euro an ounce. Then gold for a year from now is going to be 1,700 euro. Maybe there's some insurance charge or something, but without all that, the core price is going to be the same 1,700. If the policy rate was 10%, it would be 10% higher than that. It would be 1,870 to buy it a year from now, or 1,700 to buy it today. and you'd be indifferent. Because if you bought it a year from now, you could keep your money in the bank at 10%. You'd have the same amount. And if you paid the $1,800 today, if you bought it today at $1,700, well, you'd lose the interest on your money for a year, so you'd be out to $1,700, so your cost would still be $1,870 come a year from now, right? If that's when you needed it for. So that forward pricing structure is a direct function of the Fed's and the Bank of England's policy rates. And it goes per currency. Each currency has its own term structure of prices. So the academic rate of inflation, the rate of inflation as academically defined as the term structure of prices faced by real economic agents, is the policy rate, the term structure of policy rates set by the central bank. They are setting that inflation rate. Now, that doesn't mean the prices are going to go to where forward prices go to. That means right now, if the rate's 10%, you want to buy gold a year from now, you got to pay 10% more. Whether it's going to be there or not is a different question. Okay, so that's what you're facing. So for me, I fine-tune the definition of the academic definition of inflation to be this term structure of pricing. That, to me, after reading about it and reading the literature, fits with what they're getting at. And okay, if it doesn't, I've misdefined it, but so what? So what I've then done in the paper is I've got two things. I've got the price level, which changes as a function of prices paid by the state, and with relative value changing continuously by market forces. Okay, and if that changes continuously, that's because the state is continuously increasing the prices it pays. And then we have the rate of inflation, which is the term structure of prices faced by today's agents. Now, they're two different things, and they're separate. It's not to say it doesn't affect relative values today, and it's not to say that it doesn't put pressure on the state to change what prices it's paying over time. Okay, and so it doesn't mean it's without influence, but it is a separate determination. And it is a direct function of interest rates. So one's a function of prices paid and one's a function of interest rates set by the state. So you've got two different things the state is doing. It's directly changing, establishing and changing the price level through prices paid, and it's directly and changing the rate of inflation as measured as evidenced by the term structure of prices faced by the economy. Now that's an easy one to explain to the guy in the street asking you about MMT and inflation. But, look, it is what it is. If relativity is a little difficult, okay, but, it is what it is,
You're not going to change it by complaining that it's too wonky.
Yeah.
Yeah. What we didn't talk about there is the interest income channel.
Right. We haven't talked about the fiscal effect of interest rates, which is the interest income channel. So when the Fed increases, I just said that the rate they set is the rate of inflation. But when they set high rates, and as I said, it's not to say that doesn't influence, relative value in the price level and whatnot. So what it influences, interestingly enough, is it increases government spending on interest, right? Which is, of course, this basic income for people who already have money. But that's not what this discussion's about. We're not talking distributional issues yet. But you can if you want to. So what does that do? So that, the tax liabilities create a need to pay taxes and a desire to save. And that savings desire is in real terms. You wanted to save enough to be able to live for a week. You're Apple and you want cash flow enough to be able to be 3 years cash flow in case you have bad times or in case you want a big investment. The cash you want to hold relates to what it can buy. If you're walking around today with $200 in your pocket, maybe 20 years ago you were walking around with $20 in your pocket. It relates to what you can buy, how much you keep in your pocket. If you want to go at the last minute, you want to go shopping, you need a bag of groceries, $20 used to be enough. Now you need $200, right? So the desire to save relates to what it can buy. So in that sense, it's a real number. Okay, so if the government just gives you the money through interest payments that you need to pay taxes and you need to save, then the government can't spend as much at these going prices because that need for the money to pay the tax has been satisfied for free getting interest income, and now you don't need to be a soldier anymore because you're getting interest on your savings. You don't need to be a public health worker because you're getting interest on your savings. You don't need to sell tomatoes to the government anymore because you're getting interest on your savings. If the interest they were paying was enough for everybody to pay their taxes, they couldn't buy anything. So it's using up fiscal space. Now, the government still wants to buy things even though it's used up its own fiscal space. So what do? Well, they just pay higher prices, which is inflationary. I'm regressing, which shifts the price level higher. I use inflation just for the term structure of prices, right? So this is new for me. This is a little new for me too, to explain it in the explanation. So they've shifted the price level higher because they're paying this interest income out. So now the only way they can buy soldiers is to pay more. And that does a couple of things with the institutional structure we have. Number one, the higher prices cause tax liabilities to go up because a lot of taxes are based on your income. So if you're earning more income, you're paying more tax. Property taxes are based on the value of the house. So if they've caused the property values to go up, those taxes go up. So you've got a lot of tax liabilities indexed to inflation, directly or indirectly, whether that's their original purpose or not. The other thing is that savings desires go up. If you felt good with $200 in your pocket and prices have all doubled, now you want to carry $400 in your pocket, so you need to get a job to earn an extra $200. And so the government has raised the nominal savings desires by increasing the prices it's paid. So in those two, so what I'm trying to show is how the interest income causes the price level to shift higher, which is sort of a one-time event, but the interest is ongoing. So this adjustment is continuous. And it's a bit of an iteration, right? It's not a direct adjustment. And there's all kinds of cross currents going on with it. And you see it, and you see it in the data. So in 1979, we had the Fed raising rates dramatically up to, I remember watching Fed funds one day, I don't know what year it was, 28 bid, no offered on a Wednesday. But the policy rate that the New York Fed ultimately promoted was around 14, 15, 16%. And which is a whole other story. And so what happened? So we had a fiscal tightening in real terms. The budget deficit fell because tax liabilities went up. They used to call it bracket creep. If you weren't earning very much money and you were in the 10% bracket, now your income goes up and you're in the 15% bracket and then the 20% bracket. So as you earn more because of the inflation, that's the so-called inflation, the price level going up, which was all driven by the price of oil, by the way, as it went from 3 to 40, which is a huge disruptive increase over 10 years. Okay, so you had this fiscal tightening. So the budget deficit went up in nominal terms because of the inflation, but in real terms it was coming down. And so adjusted for inflation, it was coming down. And in fact, I think the public debt in 1979 in real terms actually went down. It was the same as running a budget surplus. So, if your debt's back then maybe $1 trillion, I don't know if it was, I guess it was about that high, and you had a 12% inflation rate, that meant it had to go to $1.120 trillion to stay the same. And it only went to $1.070 trillion because it was only budget deficit was only 7% of GDP, or maybe even 5%. Then in real terms, the net financial assets of the economy and what they could buy were shrinking, which is a major, not deflation. Well, it's deflationary, but it's a contractionary event, right? It's tightening. It's a major fiscal tightening. And so everything crashed at the end of 1979 or 1979. We had a really severe recession, which they blamed on the high interest rates. Well, the high interest rates only caused that because they promoted the high inflation rates, which were what was called the high inflation rates, but they promoted the upward shifts in the price level, right? As the government was paying more, oil prices went up, the government paid more, the prices went up some more. The Saudis were just raising price. They were monopolists. And they saw inflation, they just raised the price more. Then, it caused this massive fiscal contraction in real terms and caused a recession. So that's my narrative about that recession. It wasn't that the interest rates per se caused it. It was the fiscal tightening that came as a result of the rates. And at the same time, the inflation rate didn't come down because the high rates were prolonging the inflation through the channels we were talking about. And so you had the price of oil drop from 40 to 15 over a couple of years, and inflation went from, 12 to 8 or something like that. If we ever saw that kind of, if we have a 10% drop in the price of oil, we can see our CPI go flat to negative, right? But when you have high rates promoting the inflation, that doesn't happen. And so in Turkey today, with 20% interest rates, you see 20% inflation and high unemployment and low deficits. That GDP is only 35%. And that's kind of what was happening back then. And it prolonged the high interest rates prolonged the inflation for the next 10 years. We didn't get down to 3% until about 10 years later. And it was as interest rates came down, the inflation rate came down. But they were following rates down in their mind. They weren't leading them down, although they were leading them. They didn't realize that.
Have you heard of vector or autoregressor models in economics? I learned about them relatively recently, so I'm no expert on them. But they do basically, it's a way of putting the econometrics models to the test. So to sort of try and without any. Before making an assessment of how reality might work, they just simply look at the mathematical model and say, okay, what happens if I increase this variable by 1? And how does the whole equation react? Because the reason why they do this, Christian, is because a lot of the equations in economics sort of have a feedback mechanism. So one side of the equation affects the other side of the equation and vice versa, and you differentiating what affects what is the difficulty. So they test these equations to see what happens, and I'm trying to look for the paper, but one of the things that was mentioned was that when they put in a dummy kind of equation for monetary policy effectively, and what they think, and interest rates, whether interest rates affect GDP or vice versa, and what is it that affects what. And in it there was a section in which it said that there was they were very puzzled at the fact that whenever they created what they call an impulse response on the interest rate, so they increase interest rates by a unit, say, just to see what the equation would do, they saw that inflation jumped up initially, and then as an impulse response is just during one period. So the next period, the interest rate goes back to starts going back to zero, but the kind of the effect of the impulse on the interest rate kind of stays on for a few periods. And you see, so the first period, when you increase interest rate, inflation goes up, and then as the effect of that impulse goes away, inflation then comes back down as they would expect it to. So they called it a mystery, but as soon they said economists don't understand why this happens. But as soon as he said it, sort of everything that you said made sense. And I was wondering whether
Richard Warner did a paper. He was Bank of England, I think it's 2018. You can find it on interest rates, and he found that the interest rates lead inflation. So if you're raising rates, then inflation goes up. If you cut rates, then there's a lag, and then inflation comes down. So he found that in his paper. It was a pretty thorough research paper. But there have been a lot of these, and there have been mainstream papers also that have shown the same effect, and they just get ignored. And if you look at the papers that they do have, like the ECB might have a paper that they show that, if you raise interest rates by 1%, then inflation will go down by a tenth, with a 4-year lag, across 2 fiscal cycles or something. And, you know what they did, right? They charted, they commissioned 20 papers This is the best one they had. That's the one they show you. 15 of them showed it was backwards, and 5 of them showed less of an effect than that. So they took the one that made their point the best.
What I found the most interesting about these models is that they actually question quite a lot of the econometrics process. So what the economists pride themselves in the most kind of scientific side of economics.
To your point, the U.S. housing market this year, early in the year when interest rates came down and housing was going up, I guess, they said, oh, look at this interest rate, Fed's going to create this housing boom and everything. And now it's absolutely collapsed, right? And they're not saying anything about the fact that, with the lowest mortgage rates on record, we've got a housing market that's half the strength as it was, 15 years ago. And a third the strength that it was in 1972 when we had 8% mortgages, and half of what it was in 1978 when we had 14 or 15% mortgages. They just kind of ignore all that.
The way that they question things is to say that because all these equations, these econometric equations, are quite complex, and as I said, you never know what the causality is, which variable is affecting the other, and there's a kind of a feedback loop going on. At some point, they've got to make a judgment based on theory or of how they think things should work. And so the equation will have, say, 100 solutions with different values, all of which fit the equation perfectly fine. But then they will be selective about these solutions and say they will ignore all the solutions where inflation goes up when interest rate goes up, because to them it doesn't make sense. So, and then I found it really interesting because it was actually a very critical view at how preconceptions affect your judgment, your economic judgment, basically.
Yeah, and when they're talking about inflation, what are they talking about? CPI?
CPI in this case.
So in the U.S., that includes tobacco taxes, right? So if you want higher inflation, I can just raise the price of cigarettes. I can hit my target if I'm the Federal Reserve. Just increase the tax on cigarettes and you get inflation. If I want to cut inflation, I'll lower the tax on cigarettes. So you can... you can game this thing too, I guess. And they have owner equivalent rent, which, it's an interesting concept. It's not an invalid. It's a valid concept, but as a cost of living, are they trying to get at what the cost of living is, or are they trying to get at what the price level is? They're two different things. And that distinction just, is not part of these models.
It's part of the problem trying to come up with a single figure being representing of the whole economy, as if everybody was affected equally by this one figure.
It might be, but I don't think that's a major problem. It's like you're thinking GDP or something like that. The problem is they don't have the tools that they think change things don't change things. Like none of this stuff is a function of interest rates, and they think interest rates does everything. None of it's a function of QE, which doesn't do anything, right? None of it's a function of whether they taper or not. So they've got all these ineffective tools, or some of them are backwards, right? And they try to build models around them that show how effective these tools are, or they do build models. Their models show that these tools are effective. Like, how do they get a model that shows that QE is effective? There is no channel to anything. But they must have a model that shows that if you do 77 trillion of QE, GDP will go up by 0.3 or something, right? But where does this? I don't know how they get those. I've never seen one that made any sense. They say, "Oh, we're adding this much monetary stimulus. Now we need to remove it." It's like, how are you measuring how much you're adding or not? Where's your channels for adding anything? It's not there.
So turning to the upcoming European MMT conference in September, Warren, at which you are a keynote speaker and which people can attend online, I thought it might be good to go over some things you brought up when you were in Italy back in 2014. There was a fantastic speech by you that was transcribed for the New Economic Perspectives blog, which I'll link to. We've been talking about the MMT money story as it applies to currency issuing governments. And when you have a situation where you don't have a currency issuing government, things are a bit different.
Yeah. So what happened in Europe was they changed themselves into something more like the U.S. states. They had individual nations. Italy, Spain had their own currencies, lira and pesetas. So they all had their own currencies, and Greece used to set the rates for their longer-term securities. Oh, we're issuing drachma denominated 4 years at 8% today or something. They just set the rate. It was a subscription. You sign up for how many you want. They weren't auction. It all worked just fine. They never had any issues. It was the only central bank I've ever been to where the people working there, they were very nice, but they didn't care about interest rates or monetary policy or anything else. You go to the Bank of Italy and ask someone, what do you think about rates? Oh, well, we're at 11% and CPI is this and that's that. We might have to do that in currency. You ask the guy at the Bank of Greece about rates, you go, well, I don't know. What do you want to know? He didn't even want to. It's not that he was avoiding it or anything. He just didn't care. So you had all these people who didn't care, whereas all the other central banks, they were just deeply, emotionally involved in their work. Anyway, when they irrevocably locked their currencies, which I think was 1998, they put themselves in the same position as U.S. states. They went from currency issuers to currency users, as we now say. And the European Central Bank became the new Federal Reserve or Bank of England. And the European Parliament was like Congress and the UK Parliament. However, they didn't have the same mandates or authorities that the U.S. Congress would have for making laws. They had all kinds of restrictions and a minuscule budget to deal with, and they, for all practical purposes, weren't allowed to deficit spend. And meanwhile, the European, what were the member nations, or what are the member nations, became like, let's say the UK. What do you have? Cities there that have their own budgets.
Yeah, municipalities.
Municipalities, yeah. They became like municipalities, which is fine. So it's not like there's anything different there than there was in the UK or the US. They had different names, but it was the same type of organization. They became the municipalities. Now, the way the UK and the US had been running, and the way and Italy had municipalities before that, but the deficits were always at the central government level. It was the government of Italy that ran the debts of Spain or Germany. It wasn't the municipalities. Well, now they became municipalities, and they kept the debt levels that they had when they had their own currencies, which is like an impossible situation. So that's like the U.S. states. The federal government runs whatever deficit it wants, but let's say it didn't run any deficit, it had to run a small balanced budget. And then all the deficit spending, all the creation of net financial assets, all the countercyclical, had to be done by the states. And the states had debts of 100% debt to GDPs instead of 5% or whatever they did as states. It's relatively trivial. And if you look at anyone who's not a currency issuer, there was a currency user in Europe. I think it might have been, it was either Belgium or Luxembourg, who had been using French francs, and they had a 10% debt to GDP. So they had the lowest in the European Union. And that's because they were never able to do that as a municipality, which is what they were before financially. Now all the others are waltzing into this thing with 120% debt to GDPs and whatnot. It's like it doesn't work. Okay, they're in default at the beginning, and they can't fund themselves as it is. Now, I compared it in one of my papers to like water. You can start cooling water, and water will freeze at 32 degrees. But if you cool it very slowly, you can get lower than that, and it won't freeze unless there's a catalyst, like a speck of dust or something hits it. Then the whole thing freezes over. So you had this Wile E. Coyote moment, they used to call it, where he runs off a cliff and he kind of keeps running in the air until he realizes it, and then he falls to the ground. So all of Europe was in this Wile E. Coyote moment where you had an expansion, you had private sector credit expansion, the debt to GDPs were not a major problem. And then all of a sudden you get a banking crisis as a catalyst, which I think I described in 2001 how this would happen. It's in the paper I wrote. And you had all these governments were responsible for the deposit insurance for their own banks. So that's like New York being responsible for Citibank's deposit insurance, or Bank of America being insured by California. It doesn't work. You get any kind of a banking crisis, a state can't do that. They don't have the capacity to do that. The federal government can do it, right? They're spending first. They've got the correct sequence to be able to do that. So Europe, as soon as the banking crisis hit, that's when it all came apart. They couldn't do it. And I had written back then that the only answer is for the European Central Bank to write the check, which they're going to have to do one way or another, or else it's over. And that was 2012, where Mario Draghi said, we'll do what it takes to prevent default. We're not going to let anybody default, which means that maturity, your bonds are going to mature at par. And so the crisis went away. All of a sudden, the ECB is guaranteeing it. The ECB wrote the check. They also added conditionality, which said, we're going to do this, but only if you behave. And suddenly they're in charge of fiscal policy because they hold everybody hostage to being kicked out from under this umbrella where your spreads will widen and you won't be able to fund yourself. You'll be back to where you were if you don't do exactly what they tell you to do. And that's what happened to Greece. And that's what happened to Italy for a little bit.
And when you say they, Warren, are you saying the ECB?
Yeah.
Not a committee within the ECB?
I don't think so. I think it was, who makes the decision that, Italy's in violation? It used to be finance ministers or something, and they would fine them and they had to figure out how to collect. Well, that all went away. Okay, that all changed to suddenly your spreads are widening because we're going to cut you off from funding. And so that was the real control over fiscal policy. And it was mostly Mario Draghi, I think. There was probably a couple of people that he met with to discuss it. But whoever was responsible for making those kind of funding decisions at the ECB was suddenly, you had that entity in control, firm control of monetary and fiscal policy for all the members. No other central bank's ever done that. Now, the Bundesbank used to threaten interest rate increases if the government gave the union too big of a pay increase, but nothing like this. This was really very, very deep and right into the ECB's negotiating with Greece on what they have to do to be solvent, right? And so, that was different, and it remains that way today. It's the ECB has decided they will continue to fund everybody, continue the guarantee, but at the same time allow deficits to go up to 10, 12% of GDP, wherever they are now. That was all done under ECB guidance, right? So they're now in control of monetary and fiscal policy. Now, I don't know how that ties into my 2014 talk.
Your thought at the time was that the ECB should relax their deficit limit from 3% to 8% of GDP.
Oh, yeah. What I said was, at that period of time, not just there, was starting in 2012, okay, interest rates will come down now. Italy was paying 7.5%. It'll come down to 0 or whatever the policy rate is. And the government's budget will improve in the sense that their interest payments are going to go way down. But the economies are not going to get better from the low rates. They're going to get worse because they're cutting out all that interest income. And the deficits won't go down as much because the ability to pay taxes is going to fall off because of the weak economy. And that's exactly what happened. The interest rates came down quickly, the economy, and all the economies deteriorated because it was a fiscal tightening, the interest income channel that we talked about a little earlier.
So at the moment, the Stability and Growth Pact is turned off altogether until we spoke to Dirk last week, Dirk Entz, and he was talking about that. And I think that's in place until 2024.
But who turned it on or off or ignored it? It's just the ECB decided to allow these nations to do it.
Well, actually, what Dirk was saying is that there's a within the EU structure, there's a thing called, I can't remember what he called it, the European Committee, something like that, and they decide that it's an emergency.
Yeah, there's an emergency clause on the treaties, that's what he said.
That's it, yeah.
Yeah, they can decide that, but if the central bank says, well, we will guarantee that you won't default, but not at any debt you issue in excess of Maastricht limits, and we feel we're bound by the treaty, and that to override the treaty, we have to have a vote of all the members and all this stuff. Then the whole thing doesn't work, right?
No, I think this is within treaty rules. They can declare an emergency.
Got to check it. That particular group can do it.
Yeah, I think that was my.
But these countries can't fund themselves without the ECB allowing it. Yeah, behind the scenes, the ECB is there saying, "Okay, guys, what are you going to do? Well, we'll let you do this much. Yeah, you can declare an emergency and go to this and that, but you can't go there. Or we're not going to fund it. We're not going to fund it." they got the valve, the on-off switch.
My problem with this whole idea that they've switched it off, I mean, we haven't seen a massive increase in spending in the way that you would expect from such a, from the, because a lot of these countries are in desperate need, and I don't know, in Greece, for example, we've had the fires, and there's been cuts to the fire brigades, we've known, and to quite a lot of public services. I don't know if that has to do with the fact that they've got more of a right-wing government now as well. So to what extent, I mean, is it saying to the countries, oh, go ahead now, we're in an emergency now, so you can spend all you want. Don't worry about it. Just do what you need to do. But when the emergency is over, we're going to ask you to bring your debt levels back down to the 60% or however much that is.
Yeah, but it's still not, you can spend all you want. And yes, there's still the threat that afterwards, now how do they hold a country to do this? They're not going to fine them for doing it. It's because the ECB threatens to cut them off from funding. They all know that, one false move and their spreads widen out and they can't fund themselves. Okay, so they're all being held hostage by this ECB funding thing. Europe has showed how far people will go, how far you can push them before they'll revolt. I mean, Greece didn't revolt, right? It was pretty bad. And Italy is sort of, they got a somewhat strong, exit thing, but it's not enough. I mean, they don't have a majority looking to leave the euro or anything like that. And I think the reason is a couple of reasons. Number one, the euro, it was 1998 when they got locked. So it's been 23 years. So anybody under 40 has no memory of separate currencies. They might remember their grandmother gave them some currencies or something, but they were too young, right? All they know is the euro, and they could travel to different countries if they wanted to or whatnot. And they also know that they don't trust their own governments to run their own currency. So I remember during the Greek crisis, when they voted not to accept the terms of the Troika at first, they did later, but they ran a survey that said, would you rather have the Greek government running your currency or the Germans? And 70% said the Germans.
Oh my word.
Okay, now why? Okay, it's not intuitively obvious that the euro is a problem. They've had revolutions, they've had, military juntas take over, they've had, runaway inflation, they've had high unemployment, okay, and they've had currency, massive currency depreciation in the past. So this time they've got a major crisis, and they've had high unemployment and unrest and, all kinds of economic problems, but at least the currency was stable. And at least, they're safe. Nobody took, they didn't have inflation. There was no inflation. And if they traveled, the money was still worth something. So obviously the currency is the only thing that's been okay. The problem is something else, right? How could the currency be the problem? It's strong, it buys stuff, you can, it's stable, interest rates are low. They've never had these kind of low interest rates with a stable currency and no inflation. This is pretty good. Okay, that part of it's okay. The problem is corruption. They know how corrupt their governments are because all governments are corrupt. And you got a small country, it's all relatives in government. You know what they are, what they're doing, and how they've stolen money before. And so they feel like they're being punished for past sins, and they've got this huge debt from the past, fine. And so it's hard times, but look, at least the money's okay. So let's leave the money alone and fix this problem, the way we know corruption needs to be fixed, or, belt tightening or whatever, austerity, we know that's just the household analogy, right? And so, and so I think in that plus 23 years of only knowing the euro and only having a stable currency and sound money, if you want to call it that, it's not, so it's pretty hard to get anybody to revolt against the euro. It just doesn't, it's just not intuitive that the euro is a problem. Now, why did the UK leave? It wasn't because of the euro or to get your own currency. You already had that. You left for other reasons. The bananas sizes weren't right. Right? There wasn't, if you look at what the actual reasons were, they're pretty, it's just kind of an emotional thing, but you weren't leaving a currency that had been stable for 20 years to try out something new. Now, Scotland's looking to leave somehow, and they want to stay with the pound, basically. I mean, it's close maybe, but it's not overwhelming that they feel their problems are caused by the pound for the same reason. So it's not easy to get people to leave a currency that's been stable. It's a lot easier to get them to leave the drachma and go to the euro, or to give up, have their government give it up and let the Germans take it over, because Germans had a history, at least in their mind, they forget about Weimar and all that, of stable currencies, right? At least recently. And
I have one lousy hyperinflation, and you guys never let me forget it.
Yeah. So now, as far as Brexit goes, tell me if I'm wrong, but what I said at the beginning is you've already got your own currency. It's all about trade negotiations, right? I don't think there's anything else, and travel restrictions or something like that. And so now, what you're going to have to do is renegotiate all these trade agreements. Now, is there anything more to it than that, except trade agreements? You already have your own currency.
I think it's mostly trade agreements, yeah.
That's exactly what I thought when, going into it. I thought, well, in or out, that if we go out, that's the only, it's just a truckload of jobs for lawyers, basically.
Yeah, well, it's trade agreements, okay? And whether or not you're going to keep the financial sector or something. But so, and how many trade agreements are there? I thought it was 11,000, but I found out it was 14,000. That was about a year ago.
I mean, but lucky because we've got like the most adept negotiators in the world in government at the moment. I think only Donald Trump would be better, I think.
To be honest, I'd rather they didn't negotiate anything. Just leave it to the next government.
Let's say you can negotiate one a year.
Yes, yeah.
Okay, we're looking at well beyond the next ice age before you've made any progress on these things. And in the first 3 or 4 years, you haven't done any, which leads to another thing. There's no longer the competences at government levels that there used to be for whatever reason. I had a phone call with Varoufakis during the Greek thing. The guy called me up out of the blue from, I think, Paolo Bernard had pushed him to call me. And he said, well, we can't do our own currency because we don't have printers and we don't know how to print money and all this. So I said, well, you don't have to do that. You could, people will use euro or dollars for a while. It's not important. No, you have to do your own. He didn't understand the mechanics, but they didn't have the competency. They couldn't set up a central bank. They didn't know how to do that. They didn't have anybody who could do that. And I said, you could just get a commercial bank to open up another account in drachma, and that could be your central bank, and you allow other banks to use those, have accounts there and for clearing. And he just gives me this blank, response. He had no idea what I was talking about. So you don't have the competencies to do anything. There was no competency in Greece to start its own currency. There's nobody. They could leave and say we're starting our own currency, and that's as far as it would get, because it wouldn't actually be a currency started because they don't know what to do or how to do it. And it's not just currencies; it's all this stuff that these competencies have been lost at government levels. They just can't do anything.
That's a criticism I had of the UK government as well prior to, when leaving the European Union. The issue was that the politicians were more worried about, oh no, I'm going to have to do all this stuff now, actual politics. Then they seem more worried about that than about anything else, really.
Yeah, what they can do, especially in the European Union, is they can have $500 a plate lunches in Brussels and stay at $2,500 night hotels to discuss it and have meetings all over. And they've been doing that nonstop now for the last 10 years since the crisis, right? In massive numbers. And that they can do, but those people who are doing that can't do anything else. They can't come to any action out of these things where that they can make something happen. They can't even make bond issues happen, right? They've been trying to do that for a while now, Euro bonds and all these others. I think part of the problem is they just don't know how to do it. They don't know what they are or how to do it or why to do it, because the ECB can just write the checks. They don't need to do any of that. They must be listening to investment bankers trying to make fees, pushing them into this stuff, because there's no practical use for it.
Yeah, I'll just jump in here and plug two things. One is that the speech that I keep talking about that I'm going to link to.
Yeah.
In that speech, you lay out a framework for Italy to transition to the lira.
Yes.
If the EU didn't play ball. And I also think this will be relevant to our friends in the Scottish independence movement.
Yeah, and I gave them the same template. I can show you that if you want.
And also, just to plug, next week's episode will be with Tim Rideout, who, Warren, you met in Glasgow. And in that interview, Tim lays out the workings of the new Scottish central bank. So stay tuned for that.
So turning it to MMT and the environment, one discussion that comes a lot with regards to green issues is this idea of growth and what is a green world look like. And I had a brief conversation about this with Bill Mitchell a while back, and all he's mentioned was that while the world population kept on growing, then you still needed to have some growth, but we need to have a discussion as to what we're going to do about this. And I was just wondering what your view on all that was.
What strikes me is that when COVID first hit, global emissions dropped by something like 50% within a week. And we gave up non-essentials. Okay, people were still eating, people were still warm or whatever, and they had shelter and they had clothing. And we gave up a lot of things, but they were non-essential. And the progress we've made on emissions is more than anybody imagined was possible over the next 30 years, right? And then, well, okay, so did we do anything to hold on to those gains? Did we even discuss it? Was there any political movement to say, oh, you know what, something good has come out of this? We've given up what we thought were essentials, but you know what? Might have been, they're non-essentials. We can save the planet, for human life. We can cut these things 50% entirely through conservation. We've already done it. So let's, once COVID subsides, when we get the vaccines or whatever, and we start reopening, let's do it in a direction that doesn't, reproduce the level of harmful emissions we've had before. And here we are, back to the levels we were before, without even a discussion. There hasn't even been a discussion of that. Conservation alone, we can cut at least half. I used to say that all the time, and give examples of how we could do it. And we could even cut more than we did during this 50% COVID break. That was just scratching the surface, because it's mostly on what I would call frivolities. They're non-essentials, and some of them are nice and everything else. But certainly life without them is still good, and it's still 1,000 times better than it was 200 years ago. And it's not like nobody's freezing in the dark or anything like that. So there wasn't even a discussion. So how much political will is there on this issue? Now that we're back to where we started from, which is double where it was a year ago, they're talking about what over the next 20 years, holding it where it is now? No. I mean, they're still talking about cutting the increase or something, right? I mean, what kind of progress is anybody talking about with no matter how much they spend or how much they do? It's not a whole lot, and it pales compared to what we already had, which could have been the starting point for something else. So it's an absolutely squandered opportunity if we're serious about this issue. I've proposed things like, how about if we ban internet advertising?
Oh, that would be amazing.
Yeah, how much do we save in energy, all this other stuff, and emissions if we do that? How much emissions are created every time you do a search on Google or Yahoo or something? It's enormous, right? And what do we lose? We lose advertising revenues for search engines, and we lose companies' ability to market and sell things that nobody would have known about anyway. So what? How essential is it that we create all these harmful emissions to make sure that we can create these products and get people to be aware of products they've never heard of before, because we can get them to impulse buy them or something like that on the internet? How serious are we? So the answer in terms of monetary operations, in terms of real growth, which we can still have, just in areas that don't increase emissions, that includes all kinds of things. If we take all the unemployed and have them go out to old age homes and hold hands with people and tell them stories, GDP goes up. So, we count all that stuff as GDP now. taking care of each other, educational things, performance, art. If we had, expanded that, there's no emissions to speak of involved in that type of thing. That's the easy part of it. The easy part of it is the proposals that will reduce it, where we can still live a full, productive life and feel good about things. The hard part is there doesn't seem to be any political will or at the individual level to do it. We've got all these people that see plastic straws at the restaurants and get upset. They change them to paper straws and whatnot. And then, they left the house and they left the lights on and they left the air conditioning on, and then they leave the engine in the car running while they run in for something and, don't think anything of it. And the things they're doing are worth 1 million of these straws they're trying to save, right? We just created all these weapons to pollute the air, to create harmful emissions that people don't even realize they're wielding. They don't recognize that the light switch is a weapon, that fills the air with CO2 every time you flip it on. There's just no connection there. And so I don't see how, until that happens, that it's possible to make real progress or get people in office who will follow through on what can be done and can very easily be done, and what we prove can be done just in conservation without any new technology. Look, a 30-mile-an-hour speed limit for private transportation cuts gasoline consumption in half, right? And all the cars get to be a lot smaller. You don't need all this expensive safety stuff because you can't hurt yourself at 30 miles an hour. And if you want to go faster, take public. And it doesn't have to be 300 miles an hour. I mean, speed, we used to say speed costs money. How fast do you want to go? Well, speed costs energy usage. It goes up, geometrically. So we have 70 mile an hour, 60 mile an hour public transportation, and private transportation is at 30. And now all of a sudden you're going to have very, very high quality public transportation because people with money, and time is money, right? And it's one of the facts of capitalism. It's worth a whole lot more to them to go 60 instead of 30 than it is to the rest of us who don't have the kind of money they do. And so you'll see extremely high quality, reliable public transportation once you've taken away their time. Once you've said to them, no, you can't drive in your car at 30, at any more than 30, even though there's no traffic. If you want to go 60 or 70 to get to your meeting, fine, but you're going to have to go public. You're going to see some really nice, reliable public transportation. They will make it happen. Same thing. Once there are no private jets, the public jet travel is going to be, a lot better if we allow that at all. But it's going to be a lot more efficient. It's going to be a lot easier to use. Or the high-speed rail. How much time do you really save going faster? Not a lot. So that's plenty. You don't need to burn more energy to go any faster than that. People will cope. People will do their Zooms or whatever they've been doing. Transportation went way, way down the first week of COVID, almost to nothing. And it wasn't so bad. So that's the way I look at it. The physical side, call it that, is easy. The political will isn't at all there.
It's a cultural thing, isn't it?
Yeah, that's why I'm looking at, like, Sunrise, what can be done to develop a real political will if we're going to do this.
I think there's an awful lot of consumerism, but and that is damaging. That is definitely something that we need to cut down, and probably the first thing to go during the pandemic as well, which saw the huge decrease in emissions. But I do feel like the consumerism, yes, is encouraged by the ads, but there's also, I think, is used by people to substitute something more meaningful, perhaps. And there are things that we're not investing in.
Let them spend their money on downloading entertainment rather than going out and burning up, real fossil fuels or whatever they're burning up.
Yeah, or supporting a heterodox economics podcast, for instance. That's a great avenue to, put your money into for sure. Yeah. So I think that's a great place to leave it. We've been speaking with Warren Mosler, MMT founder, author of The 7 Deadly Innocent Frauds of Economic Policy, and keynote speaker at the 2021 European MMT Conference, which can be attended online in real time from anywhere in the world. And you can find links to Warren's work and all the information about the conference in the show notes for this episode. But for now, thank you so much for joining us today on the MMT podcast, Warren Mosler.
Oh!
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino, and you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.